Very good morning, everyone. This is Dr. Sanket Charkha from Sanket Institute's Savitribai Phule Pune University. We have started with the concept of economics, in which we have seen with the first chapter, that is what is the concept of economics, microeconomics, macroeconomics, and the concept of managerial economics. Second chapter, we have dealt with the concept of law of demand. Third chapter, we have focused on the concept of supply and the market orientation, that is different types of market that are into existence. And in the fourth chapter, we are dealing with the cost and output relationship. Now, in terms of the cost and output relationship, we have already covered what is the concept of cost, what are the various costs that have been there into existence, and these are the different types of cost you can see on screen with respect to total cost, fixed cost, variable cost, marginal cost, and average cost. Again, it has been further divided in respect to fixed, variable, marginal, and average. So, and again, of subdivision of fixed, variable, marginal, and average into short run cost, long run cost, and average cost. Now moving towards the cost and output relationship. So always there is a correlation or a positive relationship between the cost that has been associated for a certain product and the output that has been generated. How does this come into existence? Now let's look at from this presentation. Now, before we go proceed with this consideration, first thing that we need to understand is always anywhere in terms of economics, whenever we are dealing, always the concept of economics is applicable for either the short run or either it is applicable for the long run. Hence, we are if whenever we are studying with the concept of cost and output relationship, there are also two concepts, that is cost output relationship in the short run and cost and output relationship in the long run. Now, looking at the perspectives of what does the cost and output relationship mean? In simple terms, whenever we are manufacturing or whenever we are producing or whenever we are purchasing, now both the ends that we are looking for, if you are a manufacturer or if you are a distributor or if you are a supplier or if you are the consumer or the customer whom that is you are purchasing a certain commodity. So at both these stages, what we have to see that everyone is incurring some certain amount of cost. That is, if you are a manufacturer, then you have various costs with respect to the prime cost, direct cost, indirect cost, factory cost, admin cost, overhead cost, and so on. And if you are a consumer, then you have to consume different types of commodities, different types of material, goods and services, and your consumption pattern differs or it changes from person to person, amount to amount, and requirement to requirement. That is, if you are consuming 1 kg of sugar, then accordingly you will be in need of 40 rupees, 50 rupees, 80 rupees, and so on. If you are consuming 10 kgs of sugar, then accordingly you will be needing 400, 500, 800, and so on. So in this way, output relationship. So as and when we are incurring a certain cost, there is a relationship between the output also. Now in case of law of demand, what we have seen, always demand curve is sloping downward, wherein if the price continuously decreases, then accordingly the amount of quantity supplied increases. And in a reverse situation, in case of law of supply, if the price increases, then accordingly the quantity supplied also increases in the same fashion or in the same position. So a demand curve moving in a downward position and supply curve moving in an upward position. So at both these ends, what happen? There is a relationship between the cost and there is a relationship between the output. Cost is a consideration wherein in case of demand the price was decreasing, and in case of supply the price was increasing, that is the cost was increasing and the cost was decreasing. In case of our output, that is actually the quantity that has been demanded or the quantity that has been supplied. So here there comes the correlation or a matching between the demand and supply curve, and the matching between the demand and supply comes at a certain position wherein it is called an break even point, that is a marginal utility, wherein the demand and supply match each other and accordingly the utility is zero. In case of utility, we have seen the concept of elasticity of demand and elasticity of supply, wherein for which type of commodity there can be a unitary elastic, perfectly inelastic, and so on. So a proper correlation, proper positive relationship between the cost and output. In case of demand and supply that is into existence, that relationship is called as an cost output relationship. Now moving further, certain types of commodities wherein which are purchased very frequently over a very short period of time, for that case or for that consideration, we can call that particular valuation or that particular evaluation as cost estimation or cost and output relationship in the short run. Whereas in case of certain commodities which are purchased for a very long period of time, that is for example purchase of electronic goods, certain commodity which are of heavy vehicles, and so on, or industrial goods and services, machinery, and so on. For these particular type of commodities, the requirement is also very large, the purchase duration is also very large, and in this case what happened, the amount that has been expended is also very large. So hence in this consideration we have to understand what is the time duration that has been associated with this consideration. So in this case we have to determine the relationship between the short run and in the long run. The short run is a period which does not permit alterations in the fixed equipment and in the size of the organization. So in this case, now short run is in simple terms specifically means wherein the expenses are not of a recurring nature. Now how do or what do we call or what do we mean by recurring? That is, if it is been occurring again and again. That is, if you purchase for example 100 grams of sugar today, again you are purchasing 100 grams of sugar tomorrow, on the day after you are purchasing 100 grams of sugar again. So it is a recurring nature. But in case, for example, at once you have purchased 1 kg of sugar, then around 2 to 3 days you need not to go to the market, and accordingly for the long run, that is for at least 3 to 4 days, the sugar can be consumed, and accordingly here we can say how the consumption pattern of an individual is. So here which permits alterations in the fixed equipment. Now fixed equipment is a consideration wherein any equipment or any certain commodity or any goods or services which you are purchasing, which is either fixed or which is either installed for a longer period of time, then that relationship is called as a long run relationship. And if any of the instrument or a particular equipment or a particular goods or services which is not purchased, which is not used for a fixed period of time, which is not for a longer period, that relationship is called as a cost and output relationship in the long run. The long run is a period in which there is sufficient time to alter the equipment and the size of the organization. Output can be increased without any limit being replaced by the fixed factors of production. So here changes in the factors of production. So we do not very often purchase the land. For example, you want to establish a certain plant, that is a particular manufacturing plant has to be established. So what do? We purchase the land only once. We purchase the machinery only once. We hire the laborers only once, not very frequently. So here in this case, any relationship, any cost estimation, any output that is been generated, wherein the time duration that has been extended to a very longer period of time, that is around 3 years, 5 years, 10 years, 20 years, or 50 years, then such type of installation or provision of a consideration of the machinery or the equipments of the goods and services, it's called as the long run relationship. So here time place is not fixed, that is it is for an unlimited period of time. Now for example, take an example that is with respect to Bajaj Auto. Now Bajaj Auto is a particular organization which has been located in Nigri or Pimpri or whatever. They have different plant locations available in Pimpri Chinchwad area. Now what they have done, they have purchased the land in the year 1940s, 1950s, and the plant was established at that particular location only. And as on today also, that is 2020 or 21, the plant is located there itself. They are not changing their requirement, or they are not changing the place wherever the business has been started for. So here in this case, what do we need to understand? That if a particular business, it has been established at a certain fixed location which is not changing, then that cost output relationship is called as a long run relationship. Now, for example, you have purchased a particular flat, and in this particular flat, for which is a commercial property, you have started your business into that particular premises. Now, what do? Whenever we start a business as a particular consideration in the official premises? We do not change the business location very frequently. That is, once the business premises have been purchased, you do the furniture, you do the interiors, and accordingly for around 5 years, 10 years, 20 years, you continue to take over the business or processing activities at that particular location for a longer period of time, and not very frequently you change that location. So here in this case, whenever the location is not changed very frequently, or the factors of production are remained very stable, it does not change, it does not alter in a period of time, then such type of relationship is called as a long run relationship. Now first, okay, any difficulty at this stage? Any questions in understanding the concept of cost and output relationship in either the short run or either in the long run? Quickly.
No, sir.
No. Okay. Now moving towards the first concept, that is cost and output relationship in the short run. So short run may be studied in terms of average fixed cost, average variable cost, and average total cost. So whenever we are dealing with the concept of the consideration with respect to the short run cost, these are the various three types of cost which each and every organization has to deal with. The major components are the fixed cost, variable cost, and the total cost that have been associated with a certain product or with a certain commodity. Now, when we were understanding, or when we were dealing with the types of cost that was into existence, we also have seen that what are the various types of cost that was identified. The type of cost as per the manufacturing activity, it was the first was the prime cost, in which we have direct material, direct labor, and direct wages. In terms of the administrative cost, all the expenses related to your office was the components of the administrative cost. Factory overhead cost, the factory overhead cost was related to all the expenses, whether it is of a direct nature or indirect nature, which is specifically related to the plant location or the manufacturing activity. That is, any expenses which is being incurred on a factory perspective, that particular type of expenses was falling under the category of the factory overhead cost. And lastly, selling and distribution cost. When your actual product or when your actual commodity is ready for sell, then what do? We alter that particular product, we polish that particular product, we pack, or we use certain aesthetics, and accordingly the product is made for ready to sell in a certain market orientation. So here in this case, any cost that has been incurred to develop the sellability of that particular product, such type of cost is called as an selling and distribution cost. Now here in this case, every cost that whatever we are identifying, it is further divided into three categories. First category is the fixed cost, second category is the variable cost, and the third category is the total cost. What do we have to do? We have to combine, or we have to compile all the costs that have been taken together. That is the direct cost, the indirect cost, the factory cost, the prime cost, the administrative cost, the selling and distribution cost. When all these costs have been coming together, and when the average of all these costs it has been identified, then we can say that average of individual cost has been undertaken. Now, the individual cost that we are identifying for, every individual cost is having a different diversification or different valuation. Now, this particular valuation differs on the nature of that particular cost. Now, how do we identify the nature of cost? Either the cost can be called as a fixed cost, or it can be called as a variable cost, it can be called as a total cost. Now, what is the meaning of fixed cost? Now, whenever we purchase land, what do we do? Whenever we purchase a land, we do not change the value of a particular land which has been identified or which has been fixed. If a particular dealer or if a particular seller says you that the land is costing rupees 70 lakhs or rupees 1 crore, then accordingly that particular cost whichever you are giving to that particular seller, that particular cost is called as a fixed cost, because it does not changes. You cannot say that either I can sell it for 70 lakhs or either I can purchase it for 80 lakhs. No, the land or the costing of that particular land is very fixed and it does not changes over a period of time. What is variable cost? Now, variable cost is that particular perspective is wherein, now whenever you want to purchase a land, what do we do? The on a particular flat basis. Now, if you are going to purchase a particular flat, the rate differs from the square feet. If the area of that particular land is 1000 square feet, the rate will be different. If the area of the particular flat or that particular land is 1200 square feet or 5000 square feet or 10,000 square feet, the rate differs on what square feet you are purchasing for. So in this case, what happened? The rate is differing, the rate is variable, it is changing. So any cost which has been changing as per the need, as per the requirement, as per the consumption of that particular person, such type of cost which has been changing or it has been variable component, that particular cost is called as an variable cost. And lastly, the total cost. Now, what do we do whenever we purchase a land or whenever we purchase certain commodity or a particular flat which we are purchasing for? As the basic requirement, what do we have to pay? We have to pay the stamp duty. We have to pay the certain revenue taxes to the government. We have to pay the fees to the lawyer. We have to pay to the fees to the landlord. We have to pay the fees to the society. That is for the registration charges and the society transfer charges. Again, we have to pay a certain amount to the seller also. That is the basic price of that particular goods or services which has been determined. When all these costs have been compiled together, whenever all these costs have been taken together, then we call that particular cost as in total cost. So here in this case, we have three different types of cost that is into existence: the fixed cost, variable cost, and total cost, which needs to be identified, and accordingly it differs from person to person, product to product, and commodity to commodity. Now, moving with the first point, that is average fixed cost. The greater the output, the lower the fixed cost per unit, that is the average fixed cost, and total fixed cost remains the same and do not change with the change in output. So any cost which remains fixed over a period of time, that is whether the production, now whenever you have purchased a particular land, whether the production capacity is 1000 or the production capacity is 10,000 or 1 lakh, the cost of the land will remain same. It is not going to change. The seller will not say you that whether you manufacture one commodity, then the price of land is 10,000, and if you manufacture 10 lakh quantity, the price of the valuation of the land is 1 crore. No. If the price of the land it has been fixed by a certain purchaser or a particular seller, it remains same and it is not changing over a period of time. So cost is been fixed per unit of average quantity. So whatever average quantity that you are manufacturing, whatever you are purchasing, whenever the price remains the same, if it is not going to change as in the need or as per the manufacturing activity, then such type of cost is called as an average fixed cost. average variable cost. So in terms of variable cost, so the average variable cost will first fall and then rise as and more when the units are produced in a given place. So here in this case, whenever we say that variable cost is into existence, it changes as per your consumption. So whenever the consumption of a particular person increases or decreases, accordingly, the average variable cost also increases or also decreases. Now, example for the average variable cost, that is electricity charges, labor charges, telephone charges, and so on, or insurance premium, whatever you are paying for. Now, take an example of electricity charges. Now, electricity charges, now whenever we say, whenever a particular electricity bill which has been generated for you, what we are looking for every month our electricity bill is been changing. Now, why this particular bill of electricity changes for every month? Why it is not fixed? Because our consumption is changing. In a certain month we are consuming 150 units, in a certain month we are consuming 50 units, in a certain month we are consuming 200 units, in a certain months we are consuming 300, 400, 500 units, and so on. So whenever the cost per unit changes, that is, as the consumption changes, that is, if you are consuming 150 units, then the bill will be charged according to 150 units. If you are consuming 200 units, then the bill will be charged according to 200 units. If you are consuming only 50 units, then the bill will be charged according to 50 units. So variability. So if the units are variable, then accordingly the amount or the cost that has been associated with that particular product or commodity is also variable, is also changing, that has been associated or that has been identified. Labor cost. Labor cost is a consideration wherein if the labor is working for 8 hours, then accordingly you pay him 400 or 500. If the labor is working for 12 hours, then accordingly you pay him 500 or 600. If the labor is working for only 4 hours, then accordingly you will be paying him only 200. So labor cost, it differs on the variability, that is, as much the consumption is being undertaken. कि labor जितना काम करेगा, only when the percentage of the work that he's been doing, only that amount of payment will be done for him, and accordingly rest of the payment will not be made to that particular labor. So here in this case, we have to identify what is the cost that has been associated and how it is been varying. Now, for example, telephone expenses. Now, for a certain consideration or time being assume that you have a certain landline phone at your home, or most of the people must be having a landline phone earlier. Now, wherever we were having a landline phone, whether you consume the product, that is, if you are making the phone call or if you are not making the phone call, the bill is being charged for you for a certain period, for a specific period. That is, a minimum charges have been charged for you. Now, a particular minimum charge, that is 30 rupees. That is, whether you are making a call, then accordingly the bill will be charged. And if you are not making the call, still you will get a 30 rupees of rent that will be charged by the BSNL or MTNL, whichever connection that you are having for. So here in this case, the variable cost, which is if the number of calls done in a particular month is increased, then accordingly your bill will increase. And if the number of calls in the month is been reduced, then accordingly your bill will automatically reduce. So this is the concept of variable cost. So variable cost is the consideration wherein as per your consumption. So if the consumption increases, the cost or the value of the product increases. And if the consumption decreases or it remains stable, then accordingly there will be a fixed charge for you. And if it decreases, there will be no amount of money that will be charged for you apart from the basic charge that is being charged by a certain commodity or by a certain product. So in this way, the average variable cost is into existence, and we have to verify, we have to validate, and we have to explain about whether the cost is a fixed cost or whether the cost is an variable cost. Now, the third point that you have is average total cost. So average total cost, also known as average cost, would first decline and then rise the upwards. So here what we are looking for the average total cost. In the initial phase, the average total cost will completely decline. That is, if you want to attract the customers, if you want to develop the market rate, if you want to develop the market share or market percentage or position, then what the particular vendor or the particular seller does, he first reduces a certain price of a certain commodity at the lower level so that the consumer becomes comfortable and the need is being generated in the minds of consumer. So whenever the need is being generated, then accordingly what the company will do, the company will start increasing the price of those customers gradually, step by step or day by day. So any stage, any point wherein if the initially the particular price of the commodity is very less, and accordingly if it keeps on increasing as and when it has been required as per the terms and conditions and norms of the company, then here in this case we can say that total cost is into existence. Variable cost consists of average fixed cost plus average variable cost. So here in this case, what do we understand? It is a combination of average fixed and average variable cost. Average fixed cost is focused on a certain perspective. perspectives, wherein the cost remains fixed over a period of time, and accordingly the variable cost also keeps on changing. But in case of total cost, a balance or combination of both these particular perspectives is a consideration, wherein the total fixed cost or average variable cost remains same or it does not changes. Average fixed cost continues to fall with an increase in output, while average fixed cost for the first declines and then rises. So here in this case, what do we have to see? That average fixed cost of a certain commodity, it always fall with an increase in price. So as and when the price is increasing, the price or the valuation of a certain commodity keeps on decreasing. But accordingly, the customer can throw a certain commodity which is either needed, which is not, or which is not needed, and accordingly, based on the requirement, he can either purchase or he can reduce or decline to purchase that commodity. So here in this case, either there is a loss to the supplier or either a profit that has been gained by a certain supplier as and when the need arises. When the rise in average variable cost is mere than the drop in average of the first first fixed cost that has been identified, then the average total cost will be showing a rise. So here in this case, if there is a rise in the total fixed cost or the average fixed cost, then accordingly the same rise can be seen in terms of fixed cost that has been associated. So total fixed cost, total variable cost, and total marginal cost are a particular consideration, wherein everyone has to determine, everyone has to see about how the product has been categorized, how the product has been offered, and the customer is purchasing that particular commodity or service. So the rise in AVC, that is average variable cost, is more than the drop in average of the fixed cost, then the average total cost will be shown here. Now, moving further with the next point, that is the short run cost curve. Now here in this diagram, you can see average total cost, average fixed cost, average variable cost, and the marginal cost. Red color signifies average fixed cost, blue color signifies average variable cost, and green color defines or identifies the average total cost, whereas the red line, the violet line, the violet graph shows the concept of marginal cost. Go through it very seriously. Four curves you can see: average total cost, average fixed cost, average variable cost, and the marginal cost. So here marginal cost, now looking at the first slide or the first line that we are looking for, what is the consideration that as the price decreases, the amount of quantity also increases in the same fashion. So here the price is decreasing in a certain fashion, that is right from 40 the prices came to 35, then the price reduced to 20, then the price reduced to 10, again it reduced to the 10. But after a point of time, what happened? It cannot go to a downward position wherein the particular trader or a particular seller will not be able to position to sell a certain commodity which is at a break-even point. So ultimately, the company also wants to have to make a certain amount of profit. That was the concept of marginal cost. In case of the average fixed cost, now here average fixed cost you can see wherein it is a red color line, wherein a particular red color line is also moving in a downward position, and accordingly as per the new requirement, the average fixed cost is also in a decline mode or in a downward mode. Next we have the blue color line, that is average variable cost. Average variable cost that we have seen recently is the concept of the registration of that particular respective commodity or that respective bank which he has already meant for, or we have taken the calculations. So blue color line starting with the very nearest point of the valuation, and hence we can say that next is the average total cost, that is ATC. Average total cost, which is denoted by the green color, it specifically denotes about how does the price launches in a the launches we cannot say, but increases or decreases in very effective way, and what impact it has created on the mindsets of people. So the people of this particular country or that particular nation have a certain understanding that people who are great, people who are good, they have a certain consideration about how the product can be increased, how the product can be decreased, and how the total cost of a certain commodity can be saved. So in order to save the total cost of a certain commodity or a certain product, then we have to see that about how the valuation is been undertaken and whether it will be sustainable for the company or not. Average total cost here already I have explained. We need not to go in depth in again. So that was the concept of average total cost, and we have seen the concept of marginal cost also. So here in this case, all types of 4 type of cost we are seeing, that is how they are increasing or how they are decreasing. Every cost which is either AFC, AVC, ATC or MFC, marginal fixed cost, everyone is either increasing or everyone is either decreasing. Mostly the curves in these particular positions are of a decreasing state, wherein what we are looking for, the price of a certain commodity, whenever it reduces, the amount of quantity demanded supply also increases. But in case this is not applicable in case of law of supply. Here in this case, now moving ahead, cost and output relationship in the long run. Do we move ahead or should we stop? Is it heavy? Let me know. Or we can complete this. Hello?
Yes, sir.
Continue. Now moving with the next point, that is cost and output relationship in the long run. So first thing we have seen what is the relationship in the short run. Now moving towards the relationship in long run. So long run period enables the producers to change all the factors and will be able to meet the demand by adjusting supply, change in fixed factors like building, machinery, managerial staff, and so on. So any factor which is not changeable, which is not alterable, and which is not flexible, wherein which remains with the organization for longer period of time, for longer number of years, such type of valuation or such type of cost that has been associated or expended, it's called as fixed cost, or it's called as the long run cost, which is in terms of library. So any activity that you are doing for the very short term, and that particular activity is called activity of long run nature, wherein the long run nature can be identified, and accordingly we can say that whether the activity is improving or whether the activity is deproving. All factors should be variable in the group. So here in this case, whenever we are saying factor, land, labor, capital, enterprise, and resources, the factors of production. So the factors of production that have been associated with the land, with the Munich, always they have to see that it is always in a basic position, it is always stable, and it is not moving at these particular places. So all factors become variable in the long run. So how we can say that the factors become variable? Because in the long run, the expenditure for this particular consideration is always of a recurring nature after very long period of time. So movement of the goods and services, movement of the products or commodities from one place to another place takes a very long period of time, and accordingly here in this case there is no variations that can be identified or it can be expected for. So in the long run we have the 3 costs, that is again total cost, average cost, and marginal cost, wherein total cost is equal to total fixed cost plus total variable cost. So as I have explained earlier, whenever we want to consider, whenever we want to identify what is the valuation of total fixed cost, always the variable and marginal component has to be taken together. Unless and until we do not have a local and marginal constraint, there will be no valuation of the goods and services in an effective way, and the judgment of the business model cannot be done in an effective manner. Average cost is equal to, now AC, that is average cost is equal to total cost upon fixed cost. So here in this case, we have to identify and see that what is the various laws that have been associated with the bank balance and how do they are changing as the need that has been required. So the bank requirements, the official requirements, the funding requirement, the agency requirements, everything has to be taken into consideration, and then only the sourcing for money has to be undertaken. Next thing you have is the average total cost. With respect to average total cost is equal to total cost divided by output. Marginal cost is the change in total cost and resultant of the improvement in living. So if the standard of living is of the people is improving continuously, then we can say that the goods have been, services have been preferred in a long run, and there will be a good market situation after 5 years also, and accordingly you can predict the mindsets of the people about how do they go ahead and the valuation can be undertaken. When all the short run situations are combined, it forms the long run industry. So when now you can say that, or a particular person may say that, so for example, if 1000 ants are going together, now when 1000 ants are going together and 100 are distant from each other, then what do? They follow each other's path or each other's steps that they have undertaken. Now, if this thing has not been followed by the plants or by the machineries, then we were not able to identify why does this plant exist and how to handle or overcome the situation with respect to natural calamities of the natural plant. During the short term, demand is less and the plant's capacity is limited. So Pradeep is next. Pradeep, either the person, now Pradeep or Pradeep or whatever we are looking for the particular example. So here in this case, the person who is the demand manager or the supply manager, whether he's considering or whether he's approving himself as a recovery manager, and we have to see that how the valuation of the product or commodity has been done and in what way the preference or priority is been given at every point of time. When short-term average cost curves are such curvations are depicted. Now, last point, when we make a long run cost curve by joining the tangency points of all short run cost curve. So short run cost curve can also be together combined, and accordingly, based on the combination of the short run cost curves, a good long run cost curve can be drawn together simultaneously, and hence we can say that there is a good or common proportion about short run cost curves in the market situation or market area. Next is we use long run cost curve to decide the sales scale issues for the example mergers. So in case of a certain merger acquisition, what do? We initially tell that particular owner or that particular agent about how do we go ahead. Now whenever we want to go ahead, we ask the permission from that particular person about whether what he is expecting for what his expectations and how the valuation has to be increased or decreased. In the long run, we can build any size factory we wish, based on the anticipated demand, profits, and other considerations. So based on all these particular considerations, you have to see that which project is more profitable, where you can start your business, what is the scope, line, and functioning of that particular business activity, what products have been offered for sale, and so on. So here in this case, always there are a lot number of factors that have been associated, and how do we deal with those such factors are getting associated in the long run. And lastly, therefore, it is a word unique to say that it is a word unique, and hence the stretching of certain products or commodity cannot be taken to a maximum heights. Otherwise, the relationship with the company or organization will get spoiled, and accordingly, they will not be head for recruiting. Now, last share comes of the consideration of diagram. Now here in this case, you have short run average cost and long run average cost. So based on the average cost that has been identified, what do we need to see? We need to identify what is the valuation. So for each and every single individual valuation or transaction that you are undertaking for, you have drawn 3 curves. So this is the first curve that you can see, this is the second curve that you can see, and this is the third curve. When all the 3 curves have been joined together, if they have been combined together with respect to a support from the either the workshop or warehouse or the department, and accordingly students will be able to understand very quickly, very easily, and it will be helpful for them for the entire session. So here in this case, we can you can observe in this particular diagram that a long run cost is always stable, it is not changing, but there is movement in the particular cost curve with respect to increase or decrease. But in case of a short run cost curve, they keeps on changing or altering very frequently, and accordingly, based on this consideration, we have to identify, we have to see about what do we don't or what do we heard in the earlier lectures. So that was the concept of short run cost and the long run cost that we are looking for. So that's all for today's lecture. Thank you so much everyone for joining. Okay, any questions from your end? Sapna is there? Has she come? Hello? Sapna is there? I am posting the link of attendance in the chat box. Students to please mark their attendances accordingly. Acha, Saurabh, he has already posted. Thank you. Done? Okay, yeah, chalo. Thank you everyone for joining. Good day.
Thank you.